items on the agenda. We will go through the items as they appear on the agenda. We'll begin with item number 1.
Item number 1 is the City Administrative Officer report, City Attorney reports, and ordinances relative to additional actions required for the issuance of Los Angeles Wastewater System Subordinate Revenue Bonds, Variable Rate Refunding Series 2006A, B1, B2, C, D, and Series 2008A, B, C, D, E, F1, F2, G, and H, and consolidation of debt service reserve funds into one debt service reserve fund for the wastewater system senior lien bonds.
Yes.
Hello, my name's Marilyn Garcia. I'm a city attorney, and I'm the person who prepared the ordinances. The first ordinance relates to the establishment of debt service funds and the rebate funds for each of for the 2006 bonds and the 2008 bonds. These are mechanical funds that are set up for every bond issue. We're setting these up now, even though let me say that the Bureau of Accounting has already established accounts in their system, and so the money is flowing through as if these were established here. This is for purposes of creating a mirror image in the administrative code. And we're doing the ones for the 2008 bonds now because that transaction went so quickly that it wasn't appropriate to establish that fund concurrently with the bond deal. It would have held up closing. And the 2006 funds are established now because we noticed that they weren't established in 2006 like they should have been. But as I said, the accounting people who are the ones that really handle the money have established accounts in their systems, and the debt is being paid.
Okay. All right.
And then, should I go to the other one, or?
As in item number 1?
Well, it's all part of the first item, but it's the consolidation of the reserve fund.
Oh, okay.
Yeah, this one is an improvement on the current way the administrative code reads, and appropriately will reflect the way the legal documents are, which is for all the senior lien bonds for wastewater, there's one reserve fund established. So all the money in the reserve fund for all the bonds is available to pay any shortfall. It's just one fund. And when this bond structure was first established in '87, apparently every time there was a bond deal, they established in the ad code a reserve fund that had the name of each bond deal, and then at the end it says, but all these will be considered one. So for administrative purposes, it's just better to have one, which reflects what it should be anyway. And in fact, every year the accounting people have to add up all of this to make sure that the money in there is not too much or too little. And so by having one fund, they don't have to add anymore. So it's really an improvement in the current situation.
Okay. So it's corrective action.
Yes.
And better practices.
Mm-hmm. Yes.
Okay.
It's a good way to put it.
Thank you. We have a public comment card on item number 1. Joyce Dillard. There's a mic right there. Just one card.
I'd like to understand this a little bit more, and that's why I'm commenting in the fact that this was bonds voted on by taxpayers, and if so, was that in the language? Was it in the prospectus? I'm very concerned the wording of these with the assessed values being in the flux, really, in the county. How does this play in a downturn of
Keep going.
Potential revenue money in the assessed value property taxes that eventually gets passed to the city in one form or another? And what effects does it have in the capital being spent? But I believe these things are issued in prospectuses, and your investor has a certain concept of it, and how can you do this through just administrative code without a voter or an amendment? Okay.
I'll ask the city attorney's office to bring clarification to those points. Go ahead.
All of these matters relate to what they call wastewater bonds, which are the bonds that finance the city's sewer system. It's not all the bonds in the city. And the money that is used to repay the bonds is the sewer fees that the citizens pay that are on their DWP bill. So property taxes are not affected at all. No, it's only the fees related to your actual sewer use, related to water use, that provide the sources of money. And in fact, all of the bonds have been approved by the voters. When this legal structure was first set up in, I believe, 1986 or 1987, the city charter and state law required that these types of bonds, revenue bonds, be voter approved. And the city has gone out to the voters, I believe, 3 times, and has gotten an overall voter approval of $3.5 billion for these bonds. And the amount of bonds that have been issued is below that amount. So these bonds are voter approved.
Okay. Thank you for that explanation.
And I think that's all. Was there anything else? Okay.
Thank you. Thank you very much. Appreciate the city attorney addressing those questions of the committee and addressing the committee. There are no more public comment cards on item number 1. Public comment on item number 1 is now closed. With that, this committee will approve the CAO recommendations. Thank you. Now, item number 2.
Item number 2 is a CAO report relative to a calculation by Gardner, Underwood, and Bacon of debt service savings from repricing the MICLA 2006A financing.
Good afternoon. Natalie Brill from CAO's office. You had requested that we do independent analyses of all of our negotiated debt, and this is in response to a City Council request on February 27th that they calculate the debt service savings that the city realized from the repricing and restructuring of the senior manager of the Municipal Improvement Corporation of LA MICLA 2006A. Basically, the initial debt service was $850 million, and the final debt service was at $845 million for a savings of $5 million.
Okay. How did that come about? The $5 million savings. What do we attribute that to?
Basically, the day of the sale, we looked at who was buying the bonds and what type of structure was involved. So the underwriters looked at what was selling, what wasn't selling, and they basically restructured it. And in doing so, they were able to get a lower total interest cost to the actual sales.
Okay.
And you can see their memo. It's attached, and it goes through step by step the technical aspect of how they came about that figure.
Mm-hmm. And what do they mean by true interest cost? What does that mean?
It means the combined interest of all the different maturities. This MICLA deal was 30 years, I believe, and what they did was they looked at all the interest costs for all the maturities, and then you get, I guess it's like an average, the total interest cost that we would pay on that bond issuance. So when we calculate the debt service, it's all aggregated, and every year we pay that amount of debt service on the 4.3686%, or in this case, it's the 4.3345%.
Now, what's the difference between the 4.3686 and the 4.3345?
That was the initial debt service that was first attained, and then the final one after the restructuring. At the end of the day, when we restructured, the difference between the two is $5 million.
Okay. But what takes place between the initial debt service and the final debt service?
I believe it has to do with the difference in the retail period and institutional period. And basically, what we believe the debt service will be, it's a combination of all that. So when they add in all the different bonds that were sold.
The initial debt service is an anticipated debt, an anticipated figure?
Yes, it's the initial interest rates presented to the city the day before.
Okay.
We sold by De La Rosa. Because we have to provide a financing schedule. And so when all the underwriters get together, they do an initial debt service based on what the market will be the next day. But when we got there at 5:30 in the morning, there was incredible movement in the market that day, and interest rates started to lower, incredibly lower. I mean, it's a while ago, so I'm trying to remember the actual events, but when we got there in the morning, we already knew the market was down, which was to our advantage. So when they looked at that, their structure ended up changing from what they originally had told us. Because we sort of do a pre-pricing call the day before, and it's usually also the retail period, which means that's the day we sell to brokers and dealers that then sell to individuals. And that period had a different structure, actually, than the final one that went forward on the following day. I think we sold on a Thursday.
Okay. Now, this discussion and those definitions and that activity, the initial debt service figure and the final debt service figure, and therefore, in this particular case, there was a difference, and the difference was a net savings. Is there anything dynamically that occurred here that does or doesn't take place when if we were to handle a transaction of this magnitude and do it on a competitive basis versus negotiated?
Well, on a competitive, we have initial debt service, but that initial debt service is calculated farther in advance, because you do have a period of time from the time you advertise to the time you actually sell. I mean, the market conditions are the same. So the day of the sale, on a competitive, what would happen is that the same conditions that occurred for negotiated would occur in competitive. So the interest rate would have been low. Would it have been just as low? I don't know. But the fact that the market conditions changed from the retail period on that Wednesday to the following day, Thursday, is what caused the interest rate to go down. And one of the things that happens on a competitive deal, and happened in the past, is that there weren't so many retail purchases. It was mainly institutions. It was investment advisors. It was trust banks. It was the tender option bonds that people liked. They would hold on to bonds and they would split them up among all the different mutual funds. In the last year, we have seen that those people have gone out of the market, and it's switched more over to retail. And this was the beginning of that. When you look back, hindsight's always 20/20. When you look back, you can start seeing that retail was starting to come more into the market. Like today, you see a lot of retail, which means that people are investing in bonds versus stocks, because we know how volatile the stock market is. And whereas institutions are pulling out of bonds for whatever reason. So this was, I think, the beginning. When you look back, you kind of think, well, this is the beginning of it. And when we moved to the MICLA 2007, you saw that again. You had more retail. I mean, we had a lot of retail on the 2007 also. But you started to see this in November of 2006 when we sold. It's just the way the market was going. Would the interest rate have been much different if it had been competitive? I don't know.
But when it comes to competitive transactions versus negotiated transactions, isn't it custom and practice that on a negotiated transaction, that the day in which they enter the market, or the way in which they try to anticipate when is the best time to go in, isn't there more timeliness, of flexibility on a negotiated versus a competitive? On a competitive,
You choose a date.
They choose a date and then they just go at it. That's just the way it is.
Correct. On a negotiated, you basically, once you have your underwriters, those underwriters go out and start marketing your bonds on a negotiated. And that's what this difference is, actually. That at the beginning, they thought the interest rate would be 4.36 when they began to market the bonds. It ended up, because the market had moved from Wednesday to Thursday, it actually went down to 4.3345. So that's actually was a movement in the market. So you could say, on this particular case, if we would have gone competitive on that Thursday, the market would have moved. So it would have been better for whoever had bid. The competitive is the lowest interest cost for that particular day, while the negotiated is, it's the best one for that day, but it's also guaranteed the buyers are lined up. But it doesn't necessarily mean the buyers will get the interest rate that the underwriter first offered to them. And that's what happened here.
But you mentioned that on the competitive, in your example, that that would have been good for the bidder that day?
Yeah. Anybody who bid that day because the market had moved from Wednesday to Thursday, the issuer would have done well, meaning the city or the county, whoever, on a competitive basis because interest rates had dropped. I'm not quite sure who, if it had been competitive, who would have bought the bonds. We do know that we were oversubscribed on this, on the negotiated end. Would that have affected the interest rate on competitive? I don't know. It's a guess, and it's been so long. I just don't know.
But when somebody does business, for example, with our municipality, our city, and they win the competitive bid, isn't it custom and practice that they get out there to the market and they try to meet their objective and their mandate if they want to actually make money for doing the work?
Correct.
They have to make sure that they don't end up in a market that's worse than they had predicted and promised us as a city that they would sell those bonds for X amount.
In a negotiated, not in a competitive.
But my point is, in a competitive, when they bid it, don't they actually bid a figure?
They bid a figure the day that we sell. It's on the negotiated that you actually, if the market moved in the opposite direction and they had told us that it was the opposite, that it was 4.33 instead of 4.36, we would have had a hard time negotiating them down. In a competitive, you don't have that. Whatever the lowest bid is, you take it. So the lowest bid was 4.36 or 4.35 or 4.34. You would just take the lowest bid. On a negotiated, because we're a AA city and this deal is AA minus, you would hope that the underwriter would know enough about our credit that they would build in the fact that we would go lower, not higher. But I do know of cities that, the underwriter has told them, X, and because the market moved away from them, that they had to bid, they had to accept a higher interest rate. I mean, it's really depends on the market that day. The two deals that we did negotiated, the underwriters, I think, put enough cushion into their bids that they were able to, maybe that's not fair to them, but they were able to see things maybe in the market and able to bid at a rate and then be able to lower that rate for us. I mean, it's always great when you can tell an issuer as an underwriter, when you're sitting at the table with them, oh, we're not at 4.36, we're at 4.35. Ooh, even better yet, we're at 4.33. And the reason that happens is because you have a maturity a year. Let's say for 2010, it's $2 million for that. People want $2 million for that year. Well, and you get $4 million worth of requests. Well, you can add another $2 million and then lower the interest rate.
And that example in competitive, is it as common for them to do that activity in competitive deal than it is in negotiator, or is there any difference?
It's different in the sense that we don't see it. They do that externally between the time that before 9 a.m. So in other words, we know that they line up buyers before the 9 a.m. deadline to put in their bid. As they get calls in, because remember, it's 12 o'clock New York time, and this is all based on New York time. So between the time the stock market opens at 6 a.m. Pacific time and the time they bid at 9 a.m., those 3 hours gives them the ability to see where the market is, to see what kind of buyers they have, and then put in a bid. It's a very different process than
Well, then let me understand this. I've been on the city council where we've taken up a competitive bid, and then the council gets a list of how they ranked.
correct.
Those bidders on a competitive deal, they submit to the city how long before the council sees that envelope and we open it, and then you make the recommendation of who to go with, because quite frankly, they had the best number.
9 a.m.? They have till 9 a.m. in the morning to do that. So usually about 8:58, 8:59, we'll begin to see them come in. And the automated system that we use begins to rank them. And then at 9 o'clock, the system shuts down and no more bids are accepted.
And then you print it. That's it.
And
Those are the
then
bids.
it ranks it, we print it, and the one with the highest bid, in this case, the lowest bid,
yeah.
is the winner.
Okay. Now, once, for example, at 8:59, you see the final numbers, and then all of a sudden at 9 a.m., the CAO says, okay, you take a snapshot of that, they're ranked, done. Say the council approves it on a competitive, 99% of the time we do so, unless you were to tell us of some technical glitch or what have you, go back to the drawing board. Otherwise, we will go ahead and take the CEO's recommendation. It is what it is. Whoever's the lowest bidder, they get it. Then what to do?
Then the bonds we spend 2 weeks closing the deal, making all the documents are signed, doing all the requirements that the Securities and Exchange Commission requires, and then we exchange money usually anywhere between 8 to 14 days after the sale. So between that 2-week period, what we begin to do and the FAs begin to do, financial advisors, that we actually see, because our bonds begin to trade on what we call the secondary market, meaning the first buyer will then sell it to another buyer who will sell it to another buyer. So what we begin to see is we begin to see how our bonds are trading. If they're trading above the interest rate higher, we know that we did well because our bonds are now, we got the lowest price. If we begin to see that the bonds are actually below what our interest rate are, we know that it's called leaving money on the table, that wasn't as low as a bid as we can. In the data that we have seen in our office, about 90% of the time, our bonds trade higher on the secondary market than what we originally paid. That's how we kind of track if the underwriters on that particular day gave us a good deal or not.
Now, the underwriters, now when they bid, 9 o'clock, that's it, we take a snapshot, rank them, you present to the council, usually sometime after 10 a.m., council passes it forthwith. They start dealing with our bonds that day, or is it 2 weeks later?
I think it's 2 weeks later. I'm not really sure because we actually exchange money 2 weeks later, but I know that there sometimes, I'm not actually sure. I know that sometimes right after we close, we see things being exchanged. There must be things that go on during that 2-week period. I mean, technically they don't have the bonds yet. I mean, they're the winners, but they don't technically have the bonds yet. So I think
So
it's at the 2
lighting
week.
up goes on, but actual transaction,
No, not until they
Technical
actually
time.
own the bonds
exactly.
and we get the money. Yeah.
Okay. All right. Okay. So in a nutshell,
We did well.
yeah, this Gardner report shows that we were on the better side of the situation that day by easily $5 million.
By at least $5 million. This was the first one we had done, and we did exceptionally well on the MICLA 2006. When you see the report for MICLA 2007, you'll see we also did really well. The true test will be when we go out to issue again in a few months with the market volatility. How are we going to do? And it's going to be very interesting to see how we do in a good market and how we do on a really, it's not a bad market, it's just an unstable market.
Yeah, very unstable. Everybody I talk to in the industry, it's just kind of get a smile on their face, kind of like they're in no man's land, and just hope for the best, do the best job they can. We have one public comment card on this item. We are on item number 2. Joyce Dillard.
As far as I can tell, MICLA, or Municipal Improvement Corporation of Los Angeles, was evolved from the Olympics. So my question is, why is the City of LA still using this nonprofit corporation as a conduit, lease revenue meaning they own the property and they lease it to the city? And why are the taxpayers kind of being involved in this transaction in this way? Also, my question was about institutional owners, which she answered retail, because I know it's more retail in these bonds now. I'd also like to know what effect it's going to have on the general revenue fund if the revenue fund drops, and what we mean by redeemable, and how we play into the debt limit calculation, the maximizing debt limit calculation.
Well, first of all, Natalie, we're well within our debt limit as far as our expectation of what our latitude is when it comes to debt on our general fund, correct?
Yes, our debt coverage for non-voter approved debt, which this falls into, is 6%. We are currently including this probably like 4.2, maybe 4.3. I don't have that chart in front of me, but we're way below the city's limit.
And also, even though this is, for example, a tough budget year as far as budgeting for the coming budget year, the overall figure of the amount of money budgeted for the next budget year is larger than the last budget year, correct? In just gross figures.
For debt service?
No, I'm just talking about the general fund period.
Oh, yes, the general fund grew.
Yeah, but that's my point. I think a lot of times the general public thinks that when government says, be it Washington or Sacramento or City Hall, when they say, wow, this is a tough budget year, our revenues are off. That means they're off whatever the projection was at one time. But it doesn't necessarily mean when somebody says our revenues are off of our previous projections, it doesn't mean that we've gone down in gross figure as far as overall budgeting dollars.
For this year, it was either flat or it went down a little, but not significantly.
The general fund?
You know, I don't remember off the top of my head.
I think the general fund went up
Do you remember?
in just gross figure.
Gross figures that did go up.
Yes.
In gross, right?
Yeah.
Yeah, in gross figure.
Right. What's flat is the percent of growth then.
There you go.
Okay.
That's different.
That's different. That's what you were saying. Correct.
But just in gross dollars, if you're just talking about a dollar sign with a gross figure next to it, not percentages, we are up from the previous budgeted year.
Yes.
Okay, that's what I mean.
Yes.
But the reason why I go through that on the record is because I think the public gets a little confused because they hear that City Hall doesn't feel like they're getting as much money coming in the coffers in the next 12 months based on maybe a year ago what we projected for the 08-09 budget year. It doesn't necessarily mean that we're getting less dollars than we did in the previous budget year. And this was a perfect example. Very, very tough budget year that we just finished our budgeting process. But based on our projections, even at that, next year we will have more dollars to work with than we did in the previous budgeted year, which is the year we're currently in. Okay. Okay. So we're well within our own limit that we impose upon ourselves as to how much general fund
Yes.
we're willing to bond against. Okay. All right. Any more public comment cards from the public? Seeing and hearing none, public comment on item number 2 is now closed. With that, we'll note and file the report. Thank you.
Thank you.
We now move to item number 3.
Item number 3 is a CAO report relative to a qualified list of investment banking services for city bond programs.
Excellent. Where we at?
Right here.
Okay.
Hi, my name is Hato, Office of the CAO. Last December, Council and Mayor authorized this office to release an RFQ for investment banking services for negotiated bond sales. Our office completed an extensive and rigorous review of the 38 proposals that were received. As a result, we are now recommending 17 underwriting firms to serve on at least one of the 4 pools over a 3-year period. These firms will be assigned as a senior manager or a co-manager for the following type of debt. In Pool 1 is long-term debt. We're recommending 11 firms. In Pool 2, we're recommending 7 remarketing agents for variable rate debt and commercial paper. In Pool 3 is our land secured assessments. We originally recommended 5 firms, but UBS exited the municipal bond market. So we would like to add in De La Rosa, which will make 5 firms for Pool 3. In Pool 4, that's our unique financing. That's such as like pension obligation bonds, public and private partnerships. And in that pool, we have 7. We had originally 8 firms, but UBS exited the market. So we were down to 7, and now we would like to add Goldman as our 8th.
Now, on the land secured assessment, somebody dropped out of the top 5?
Yeah, that was UBS.
Okay. And then, so therefore, you're recommending the person who came ranked 6th, which now pushes them up to 5 to be included as the 5th?
Correct.
Okay.
You could, in attachment 2, you'll see a ranking.
Uh-huh. Yeah, on the
And you see in
land
Pool
secured,
3.
De La Rosa ranked number 6. So you're saying the one that ranked 3rd dropped out? They declined?
They dropped out of the municipal bond market, so we're just taking them off the list.
Okay. And on the number 4 pool, as I have it, unique types of transactions, such as public-private partnerships and pension obligation bonds, there were 25 respondents?
Correct. 25 applied for Pool 4.
Okay. And UBS,
UBS was ranked 4th.
and they're out?
Yeah.
Okay. So UBS ranked 4th, so they were out. So that means that everybody in ranking, number 6 is Loop, number 7 is Ramirez, number 8 is City, then we have Goldman.
So we want to add Goldman in since UBS exited the market. So it just pushes everyone up 1 rank.
All right. I want to make sure we have things in order on the recommendations. We have Merrill Lynch, Ramirez, Siebert Branford. Siebert Branford, I don't see them on the ranking or the response. Am I missing?
Are you looking at Pool 4?
Yeah, Pool 4, unique financings is labeled. JP Morgan, Merrill Lynch, Cabrera, UBS
Okay,
out,
number
Siebert,
5.
Loop, Ramirez City,
On
Goldman.
Pool 4, the number 5.
Oh, I'm sorry, thank you.
Yeah, we just abbreviated by Siebert, sorry about that.
Okay, I was looking for a long name.
Right.
Okay,
Now, you have to realize that not all the firms applied for everything.
exactly.
So that's, if there's somebody you're missing, it probably means they didn't apply.
Yeah. Okay. 2, 3. And we had discussions about the sizes of the pools. How do you feel about the size of the number of firms that we would have in each pool?
We feel that is
Workable, I mean,
sufficient.
Sufficient, well, it's sufficient for sure, because your initial recommendation was pools of smaller numbers of firms, not smaller firms, smaller numbers of firms in the final pool. And we were talking about having them larger than that. And one of them is 11, the other one is 7. Pool number 3 would be 5, correct?
Correct.
And then pool number 4 would be 8. Is that correct?
Correct.
Okay. All right. Now, again, unless I'm seeing something wrong or that I'm missing, pool number 3, the land secured assessment pool, that one, you recommended, your initial recommendation was going to be 4 or 5?
5.
Because on the ranking, there are 5 firms that are in bold.
Yeah, UBS was the third.
Uh-huh.
So since they exited the municipal bond market, we're going to cross them out and add in De La Rosa. So that brings it back to 5.
Okay. And then on your ranking, on the 4th, unique financings, you had 8 in bold. So 9 goes to actually number 8
Correct.
if UPS no longer exists. Okay, all right. Same thing. Okay. All right. Anything we learned in this process? Anything happened differently? Anything that comes to mind? Because we had a lot of discussions over the last few years about these pools, and before we didn't used to rank them in categories of pools, correct? This is the first time, correct?
Correct. We used to do, we did have a negotiated deal. We would do it deal by deal, which was a lot of work. This is much better,
Oh, good.
having a pool. Oh, yes.
Good.
It was grueling, having 4 days of interviews, but at the end of the day, I think that it was good.
Okay.
And I think that all the firms were, who came to interview were very pleased that they were able to interview.
Okay. And the number of responses? Do we normally have, what did we have, 30-some
38,
responses?
overwhelming. But we're not the only ones. My understanding is that Harbor had 31. So because the market is so unstable right now, I think that everybody knows that we'll probably be doing a lot more negotiated. There is, unless it's something what we call, vanilla, plain like a general obligation bond or a TRAN, we probably, if the numbers work out, will be doing negotiated. I just don't see us doing competitive in this market. It's too volatile.
All right.
So people know that we'll be having quite a bit of deals moving forward.
Well, I'd like to think that the fact that this committee has had open hearings and we've had all this dialogue and stuff like that, and even some interesting newspaper articles, that people are starting to pay a little bit more attention and realize that we're willing to be a little bit more involving ourselves with firms, both small, medium, and large. In my opinion, it seemed like the bigger firms seem to be extremely consistent, constantly knocking on the door of our DWP, of our ports and our airports in the city, and rightfully so, as big as they are, capable of handling transactions, whatever we throw at them. And I think that now what we're seeing is a mixture of smaller and medium-sized firms that are probably responding more and feeling better about their chance of competing with the big ones.
And I think that you'll see that the lists we felt were very balanced. We took
Yes.
that into account.
Yes.
I mean,
I
obviously, you
agree.
can't compare a small to a large, but you can look at the capabilities of small and then rank them. And I think that's what we tried to do. We tried to look at each firm and what their capabilities are, and even themselves put limitations on themselves. And we're aware of that, but I think it also
And that's
gives us...
healthy, because the
Very
bottom line
healthy.
is, we know enough about these firms now and the reason why they were chosen to be in the pools, because they have certain capabilities, and once they're tapped on the shoulder to handle a transaction within that category of their capability, we expect that they're going to do a good job.
Yes.
Okay. And most recently, in the last few years, I think we've had some different names involved, and I don't think we've had any disappointments to speak of. I mean, This is a very fluid, like as we talked about in the previous item, it's one thing to be able to pinpoint what happened, and with 20/20 hindsight, we can say not only did we think it went well that day, we're starting to realize why things happened and why it came about. I think that when we look back, we can see that that so far, no regrets. We're a little bit more dynamic in this city. We're involving more of qualified organizations, and so far so good. Good. All right. Any public comments on item number 3? We do have a public comment card on our next item, number 4, but we are now on item number 3. Public comment on item number 3 is now open. Seeing and hearing no public comment on item number 3, public comment on item number 3 is now closed. With that, we'll approve the CAO recommendations with those 2 clarifications. On pool number 3, the land secured assessment, it is recommended that it be 5 firms, the 5th firm being De La Rosa, and pool number 4, unique transactions pool, that there'll be 8 firms, including Goldman, which would be number 8, correct?
Correct.
Okay.
Thank you.
All right. With that, this item is approved. Thank you very much. Now move to item number 4.
Item number 4 is motion Zine Cardenas relative to a request for a detailed analysis of the city's exposure to the current credit crisis as it relates to municipal bonds, including the proportion of city-issued bonds that are fixed rate and auction rate, a discussion of any relationships between the city and private bond insurers, and the overall impact of changes in the bond market to the city's debt financing costs.
When we were looking at how to present this to you, we kind of did something unique. We decided that we would present it to you visually. I think you'll have a better idea. It's just too dynamic, I think, to be doing. What you see in front of you is a template that we use for all our presentations. The pictures change from time to time, but I think it's a good, it's my favorite page. It shows you a good views of different parts of the city. Sometimes we put beach in, sometimes we put the Cascades in. I mean, it just really depends on what pictures we can pull up. We like it.
They are pretty.
Yeah, it's a great page. I'm sorry this is so far away. Basically, we wanted to start off with giving you a synopsis of our debt portfolio. This gives you an idea of how much debt we've issued and where our debt lies. You can see the voter-approved debts in green, and the other debt would be that debt that's non-voter approved, as it matched up with our charts. We do have a $5.5 billion debt portfolio. That's how much debt we currently have outstanding. And I tried to outline for you the major categories. The asterisk below says as of July 1st, 2006. It's actually as of July 1st, 2008. You will see that we are a AA rated agency. The only thing that's not AA, you can see, is the wastewater system subordinate. And that's because it's subordinate debt to the seniors, so it's always one notch below. I really want to focus on variable rate debt because that is where the impact of the insurers has really affected us. When you buy insurance for fixed rate debt, you buy the insurance, you sell the debt, you're done. We care what happens in the secondary market, but it doesn't necessarily affect the city. Variable rate debt, the policy was adopted in April 2003 prior to our first general fund variable debt transaction, which was the convention center. We adopted 2 policies then. We adopted one on swaps as well as one on variable rate debt. Basically, we were trying to integrate variable rate debt into our overall program. The council approved parameters, which basically said no more to 20 or 25% of our outstanding unhedged debt, meaning no debt secured by swaps, would be variable rate debt. We were to look at debt also as balance sheet risk mitigation to see how much, what our portfolio on the investment side looked like. and also is interim financing. And that's one of the reasons we did a MICLA CP program, to lower the cost of debt. Every quarter, we do provide you with a monitoring of our variable rate debt. This basically just tells you what variable debt rate is. It's basically long-term debt that resets every week, every month. Investors can put the bonds, which means they can put the bonds back to the bank and say, we don't want them. And it also has what's called a bank credit facility, basically guaranteed by a bank in case the variable rate debt goes sour. One of the reasons you do variable rate debt is that it can give you greater savings when the fixed rate market is high. You have cash out there that is earning low interest rates, so you match your debt with also low interest rates. There is relationships historically that indicate that long-term average cost is less than fixed rate bonds. The nice thing about variable rate debts can be refinanced at any time, and they do set weekly or monthly or daily. But fixed rate debt, as you know, usually has what we call a call feature, which means you're guaranteeing you won't refund the bonds for 10 years. You also have risk, which is the interest rates and the credit enhancement costs, which has become very important today in today's market. By credit enhancement, we mean something that backs up the debt. It's usually done by a letter of credit that's issued by a bank. And so it's not your credit rating, it's the bank's credit rating. You can also have a line of credit or liquidity, which is not a full guaranteed, but you also have bond insurance on top of it. And so that guarantees the bondholders that you're going to pay the debt. And the terms are usually 1 to 7 years with options to renew. And the fees for this type of credit enhancement are paid annually or quarterly based on how the deal is set up. The interest coverage is determined by the amount of interest you would pay in any period, the reinstatement period, and the remedy period. Rating agencies look at two components when they're giving us our ratings. They basically look at the issuer and they look at the credit enhancement. And in the past, when you've done variable rate debt that's been insured and has a credit facility, we haven't worried about our own ratings. We really haven't, because they were previously insured, so we didn't think we needed ratings. These just go through what it means to have the issuer as a source of repayment. It means that we have adequate resources for bond payments, that we have the financial expertise to manage, for example, convention center and wastewater, which are set every week. We also have good investment policies, and that the staff has the expertise, has the training to be able to manage them. With the credit enhancement provider as a source of repayment, it's basically irrevocable. And this becomes important when we're talking about bond insurance. The credit providers looked at to make sure they have sufficient funds held according to federal banking regulations. The legal documents would delineate the responsibilities. The investor is protected from any type of bankruptcy that would occur in the city or with the bank. And also that there are extension provisions in these credit provisions, so the investor is protected. Now we hit the important part, which is the municipal bond insurance crisis. These are the insurance companies that were basically on the market before. We actually were insured in our different programs by AMBAC, FIGIC, MBIA, and XL Capital. You can see by November of 2007 that Morgan Stanley had come out and basically said that a decline in bond insurers' credit ratings would have significant negative impact on the municipal markets. We anticipate that bond insurers will undertake extensive capital raising efforts in order to preserve their ratings. Basically what happened is the bond insurers invested in these collateralized debt obligations and the subprime mortgage loans, causing very large losses and subsequent downgrades to their credit ratings. The New York Times said in March 2003, as we saw that it really was having a negative effect, that rating agencies in general were assigning municipal borrowers low credit scores compared to these insurance corporations, that taxpayers would ultimately pay the price, the officials say, and in the form of higher fees and interest rates. The URTI also said that the amount of defaults in the municipal market were nothing compared to those defaults in the corporate market, and therefore we couldn't understand why the downgrade of the bond insurers was affecting our interest rates. Sorry this is so blurry, but this basically is as of June 27th, which is the latest chart I could find. Thank you. And basically it shows that where we are on all of these. AMBAC is rated basically AA, and they're on negative watch. Financial Guarantee Insurance Company, FIGIC, was downgraded into the Bs with negative. MBIA, again, AA with negative. XL Capital into the Bs with negative. And these are the big ones that the city has used for variable rate debt. Our first indication that something was wrong was in wastewater, as interest rates began to rise between 5 to 7% when they had been in the 2%. And as you know, we came rather quickly to you, and we tried to come rather quickly to you, and we basically needed to terminate the insurance policies. Well, basically, the way insurance works in the municipal market is you can't terminate unless you have their consent or bondholders' consent. So the only way to get out of it was to either refund or get their consent. Well, neither FIGIC nor XL Capital were quote-unquote playing with us, not by any fault of their own, but just because of the rules of the market that were imposed on them. So our only option for the 2001-2006 bonds, as we came to you, was really to refund. The reason that we looked at refunding was because the 2006 bonds were hedged by 2 swaps. As I discussed before, a lot of times variable rate debt was hedged, so it would actually reduce the interest rate for us. But yet it was supposed to protect the variable rate bonds. We tried to add the wastewater ratings to the bank to make our credit also as responsible as the bond insurer's credit. Unwilling to do so. Again, it has to do
Natalie,
with...
Who was unwilling?
When we went out with the banks, basically it was the insurance company's ratings that was used for the bank to have us as, or for us to be able to purchase credit. When the bond insurers were downgraded, we went back to the banks and said, add us also as the credit. Well, that required insurer consent, and they wouldn't consent again. So we couldn't do that. Also, we talked about converting to 2001s, which was true variable rate debt, to fixed rate, but the interest rates were still too high on the fixed rate compared to the variable. So our actual plan that we presented to Mayor and Council and you approved was to keep the swaps in place. And one of the problems we had is we had what we call a termination payment. If you go to the swap provider and say, okay, 30 days, I want to get out of this swap. I don't want to exchange money with you anymore. Since we were asking for it, we would have had about a $7 million termination payment out of wastewater. And we said, no way. We have to find a better solution than that. So what we did is we refunded $440 million, and we put into commercial paper $160 million. The 2 banks that extended credit to us were Bank of America and Bank of Nova Scotia. Those were the only 2 banks who extended credit to us. JP Morgan was out of the market. Dexia was at its limit. Who else did we go to? Bank of New York said no. All of them basically said no. And you have to realize because every other issuer was doing exactly the same thing that we were doing. Weekly interest rates dropped from between 5 and 7% to 1.2 and 1.5%. So we're doing great in wastewater right now. And the irony of all this is that in March, April, we got upgraded by Moody's from AA minus to AA. So while all this was going on, our credit itself, the wastewater credit, was seen as just as good as credit as the city's general credit. But the investors were more concerned with the bond insurance than with our credit. And that's one of the reasons you saw Bill Lockyer, the state treasurer, having issues because he couldn't understand why investors were so fickle about that. Convention Center is now our problem child. AMBAC, which is another one of the insurance companies, was recently downgraded, and we're again seeing interest rates going from 5 to 8%. So we're in the process in a few weeks of coming to you with our solution. Again, there's a swap involved in this one. One of the difference between Convention Center and wastewater is that the swap in this case may or may not require termination payment. We actually may get money back depending on where the swap lands in the market. So that's why this one, we have a little bit more options. And here you can see how the Convention Center debt is spread between Goldman and Bear Stearns, which doesn't exist anymore, it's really JP Morgan, De La Rosa, Loop Capital, and Jackson. So you can see here that our bonds, are in crisis. One of the ironies of all this is that when banks take over our bonds, we have an agreement of what the maximum interest rate can be. The market is a little bit on its head right now. If the underwriters were to give all our bonds to the bank, we would be paying a lower interest rate than the market is actually giving us. But because by federal law, the underwriters have to remarket our debt, we are paying more interest to investors than we would be if the bank took over our bonds, which never happens. I mean, it's just ironic. Because the time we did the 2003, interest rates were very low. So it was, prime plus 1 or prime plus, 0.5. It's just the market is a little bit topsy-turvy. So we had a call with Goldman, who was the lead underwriter on this yesterday, and they basically said to us, you know what, even though we've put bonds to the bank, we have to keep going and try to remarket by federal law. So basically, the effect of the credit crisis has been on our variable rate deal. One of the things that we have been doing is looking how much we have actually paid in insurance premiums since the year 2000. We've paid about $20 million in insurance premiums. What's the difference between the AA and the AAA? At the time that the analysis was done, it would have cost us more than $20 million if we would have stayed at AA. After talking to some underwriters, it's pretty clear that the investor right now doesn't want anything with insurance on it. How long that we continue, we don't know. There's only really one insurer right now, FSA, in the market. Their premiums have gotten very high. Warren Buffett tried to start a municipal bond insurer also. They're extremely expensive. So conventional wisdom kind of tells you that the city can probably go forward on its own with AA without insurance. It's really going to be what the market can bear. But as of this point, I personally don't see how we could have bond insurance. I probably may eat my words, but at this point in time, I just don't see it.
Now, there's nothing that requires us to have insurance.
No.
It's an internal decision for us to decide if we're going to go out there with some bonds and have them with insurance or without insurance.
Correct. It's actually a financial decision. It's a market decision. If the investor wants insurance, when the underwriter goes out and says, I want to sell you $5 million worth of bonds, they'll come back and say, well, I want it insured. So then the underwriter would go out and buy insurance. And that's why our bonds were insured, because the market was requiring it.
Mm-hmm.
But
and right now the market, because
very
the
rarely.
Insurance firms are in such volatility that they're willing to deal with a big city like us without insurance, and our bonds are still marketable.
Correct. The market has shifted from insurance credit to traditionally where 10 years ago or 15 years ago where we was looking at the issuer and looking at the city of LA and looking at, well, where are their problems? Where are their pluses? How are they managing their budget? How are they managing, their fund balance, which is an accounting term. How are they managing the cash they have on hand? It's moved. When I first started this job in 2000, everybody had insurance, and that's what the problem has been. Now, as far as auction rate securities are concerned, we never did it. And the reason was because we were a AA city. We could get a letter of credit and issue variable rate bonds at a better rate than issuing auction rate securities, because auction rate securities did not require a letter of credit or insurance or anything. It was just auctioned off. And that's where people got into trouble. We believe today that the auction rate security market is dead. Doesn't mean it won't ever come back, but it's an instrument that was used successfully for 5 or 6 years, and now it's gone.
Okay. Anything else on that point? Okay. And you'll have that, when will you have that PowerPoint ready to be distributed? I didn't get a copy.
No, I will send you all a copy.
Okay.
It'll come to your office. I apologize for that.
Thank you. I followed it. It's just fine. I just want to make sure that we have them to the committee for the record.
Okay.
We do have a public comment card on this item. Joyce Dillard.
Milken Institution hosted an event. There were supposed to be 2 men out from the Treasury Department. There was one economist, the other one was actually preparing for a meeting with the banks. And it is a fragile time. It did hit the banks. One question was asked, did it hit the hedge funds, this subprime rate? And no, it hit the banks, and that's what I think you just heard in the presentation. And because of the devaluation or potential devaluation across the country, it's very fragile. That's why they're meeting in Washington to kind of see how they're going to handle it. California was one of 4 states that had a bubble: California, Arizona, Nevada, and Florida. So what goes up comes down in bubbles. It wasn't a weak economy like you mentioned before in the budget going up. So that fits into what's said. But with that, the 5% of mortgages in trouble are going to affect the 95%. And that was hard to listen to because it is fragile now. So with debt, I think the more disclosure, the more analysis, the more keeping in touch with what's going nationally, the better for the city and the taxpayer here. What we don't want to get is being in a future negative position or assessed valuations that go down or overspending versus what can come in. And I believe that presentation may be on the website now. I haven't looked, but it was supposed to be. But I really think getting in touch with what's going on in Washington, D.C., especially with the city that's the second largest in the country, is very necessary at this point. So I appreciate hearing some of what you said, but I also know it's much more fragile. And that was the surprise to everyone there, because you're dealing with people who are, a lot of them are in the business, and they're sitting there knowing that things aren't rosy. And the whole thing is to see what you can do before it gets to a point of being impossible to handle. I mean, that's the whole strategy in this. Thank you.
Thank you.
One of the things I do want to tell the committee is that the sales office currently sits on the debt committee of the Government Finance Officers Association. And the comment is very apropos that one of the things that is going on in Washington is looking at the rating agencies, the insurers, and seeing how to better regulate them. And being on the committee, we comment on all of those SEC, IRS, Department of Justice, Department of Treasury comments and new regulations that come out. So since we are the second largest city, it is important for us to have a voice, and I believe that we are doing that by staying on that committee. And it's a very interesting committee. Somebody from Barry Frank's office came and spoke to us, and what they want to do to regulate more the municipal market. And it is important that it's regulated, because it is taxpayer dollars.
Okay, thank you. Okay, anybody else here for public comment on item number 4? We did have one public comment card, and that person did provide comment. With that, public comment on item number 4 is now closed. We appreciate the presentation and report as submitted to this committee. When will the reports be forwarded? The report be
Today,
forwarded
I'll
today?
put a cover letter on it, and we'll send it forward to the city clerk. We'll send it to Lorraine. to you, and
Okay.
then you can
So-
forward it. And then you can decide if you'd like a presentation in council or just to see the presentation.
Okay, all right. I'll talk to the author of the motion about that as well. Okay, with that, this item's approved, and that covers the 4 items on the agenda to this committee today. Is there anybody here for general public comment? General public comment is now open. Seeing and hearing none, general public comment is now closed. With that, this committee is now adjourned. Thank you.
Thank you.